Hello, and welcome to Jane's LME Addiction, a Cloud9 Fin podcast where we talk about all things liability management. With me today is Morgan O'Neill from Soundpoint. Thanks so much for coming in.
Thanks so much for having me.
So, before we jump into any main LME topic, I'd love for you to just tell us a little bit more about your role and Soundpoint in general and their focus in this space.
Yeah, so Soundpoint, if you've heard of us, we're a $43 billion credit-focused asset manager.
So very small.
Yes. Super, super small. You never would have heard of us. But in your space, we're relevant because we are a top 10 CLO issuer globally, and my business is in the private credit vertical, and our business is called Capital Solutions. And I am a portfolio manager on that business.
Very cool. And so, I mean, this is like your moment, you know, in the LME space. It seems like the two most popular things are how CLOs CLOs are taking more control in this process than we've seen maybe in 5 years ago. And also that private credit is becoming much more relevant.
Yeah. So before I came to Soundpoint, I was at HPS Investment Partners, another small private credit firm
that I've obviously never heard of.
That you may not have heard of. But if you think about what private credit first principles is meant to do, it's supposed to be the fast money and the smart money. Like that is what it's supposed to do. So if you think about what an LME is supposed to do, quick solve for a company, get some more runway to lead to a broader solve. And what private credit is supposed to do, like they are a natural fit together. I think within the tradable term loan space, like in the broadly syndicated loan market, sometimes it makes sense for CLOs to put in new money. Sometimes it doesn't. It really just depends on the CLO. If the CLO is post reinvestment period or pre-reinvestment period. So if you consider a credit that is troubled, it's trading off, maybe it gets downgraded, and the majority of holders of that tradable credit are in post their reinvestment period, they can't even put in new money really if they wanted to, or it would be very hard for them to do so. So private credit,
it seems like in the past, you know, that's where the CLOs were exploited.
Yeah, as a forced seller. But yes, there are ways around it within the language. Of course, CLOs post the reinvestment period can put in new money to defend their position. But taking advantage of that vacuum in the market, that's kind of where private credit is. The best place to be at in the convergence of private credit and LMEs is kind of where you can track everything that's going on in the public markets, but you're kind of sitting there waiting to put in the new money. That's what my team hopes to do. Yes.
Okay.
So we're watching everything that goes on in the public markets. We have analyst coverage across every name in the broadly syndicated loan market, but then my team is there to really assist with the new money.
Okay. And so another thing that we're sort of seeing in the market is this concept of deals away, where, I mean, if you want to explain what that is, I'm happy to, or I'll let you.
Yeah. So I think historically, we have been approached by a bunch of lawyers and representing a company asking for a term sheet to assist to take it back to their ad hoc group and kind of make their ad hoc group do something like that. That's kind of the bare bones framework of where private credit has traditionally assisted with the LME situation. I think that there are some red flags and green flags to tell if you are just a backstop commitment or if the company is really thinking about doing an LME. And that can determine credibility for if you think there's going to be a deal away or not.
I love that concept of red flags and green flags, because I mean, where I sit a lot of times is sort of this binary conversation of, are deals away dead or are they alive and well? And I mean, the way that you're saying it has like a lot more nuance to it of it's not necessarily dead or alive. It's just there are red flags and there are green flags. So can you walk us through some of those red flags and green flags?
Yeah, I think a couple red flags red flag number one is when you get approached and the diligence packet is maybe like a skinny deck. They're going to do this drop down. They have like a skinny deck together. It's a model showing like 5% revenue growth year over year. And like, here's EBITDA. And on the term sheet that you submit, can you say you're going to close in 2 weeks? So that's red flag number one. You can
tell information and quick speed.
And companies very sensitive to economics. Like something like that, you can tell that's a red flag.
But do red flags come with? Actually, I'll wait.
No, please. Another red flag would be fill out this grid. So here's this grid, and it almost looks copied and pasted from the company's existing public credit doc in terms of like builder capacity, incurrence, et cetera. And as you probably know, that framework does not exist in the same format in private credit, especially within special situations. Private credit basket capacity just does not work in the same way. So that's another red flag. And you can tell the company has not necessarily considered a private credit solution because they expect the same capacity that is in their public credit doc. Conversely, a green flag would be if you're talking to the company about their turnaround plan and you can somehow put covenants to that. That tells me that the company really believes in what they're going to do. They're willing to like put their money where their mouth is, and this is how they feel that they're going to find a solution.
And that they're looking for a real new partner.
Real new partner, yes.
Any other green flags?
Yeah, I think it's very clear. It's almost paradoxical how clear it is from reviewing the diligence if you think that this is a real solution or not if you're the company.
Okay.
Because a company is not going to burn a lot of calories on just trying to get a backstop term sheet to take to their ad hoc group to try to force them into an A&E.
So the other main conversation that usually goes hand in hand with deals away are the fees. And so regardless of if it's a red flag or green flag situation, do you get a fee? Or only in the green flag situations because?
It's quite nuanced. It almost, if a company feels like they are going to reach a solution with private credit, they almost always pay a fee. So therefore, it's almost more credible for a company to take back to their ad hoc group, hey, we've paid a fee and this is our backstop commitment. I'm obviously not biased, but the way that we charge fees is we'll pick the minimum amount of time we need to actually underwrite a credit and get to a closing. So if a company needs to close by December 31st and they want to maintain optionality all the way through the time period between now and December 31st, you just say, I need to know by December 4th if you're going with me or not. And by December 5th, like I don't have enough time to close by December 31st and I need to get paid to do work. So if you want to maintain your optionality and not give me exclusivity, you have to pay a backstop fee. I think that makes sense. Given there's so much supply in private credit and these deals are attractive relative to other things in the market, think about it. It's like new money into a situation where one of the worst cases is already played out and some of the dominoes have already fallen. So you might not always get your fee if it's complicated enough, juicy enough, and or check size is a big determinant as well, because some competitors will in the private credit space will only spend time if it's going to be a big check. Those would be some of the reasons where even if you are going to be working until the date that you need to close and you're not granted exclusivity, you might just do it without a fee.
Yeah, so that brings me to Tropicana, which I think is one of the more interesting almost deals away, or at least we think that it almost happened at least, where there was sort of a question as to whether or not TPG actually got their fee. And so that was like, if you were looking at that situation, armchair expert here, what does that say about just deals at large? And like, if you guys were looking at a situation, right, how likely is it that a fee is discussed, but then you don't actually sign, I guess, and it may not happen?
It's a great question. And I'm very sensitive about this because very recently, actually, our term sheet, and we did not collect a backstop fee for this, was used to get a strategic deal done, not unlike the post-Tropicana situation, for another credit. So sometimes your deal can, for the LME, your term sheet can justify value being there that can force other people to do things.
Right. And
not
without,
just,
without actually having that sort of LOI that has like,
exactly.
Yeah. Okay. Interesting.
Right. And not just from an existing lender perspective, because the existing lender perspective is I might be primed, they're taking something from me, but from a strategic perspective, people seeing a refinanceability or a financeability of a certain asset might catalyze some interest in that asset.
Really interesting. And so, yeah, I think that that's in general when we look at these, right? And the deal ends up going to the lenders or or the close group. I guess, how do you think about long term, like what the right solution is? Is it sometimes when these deals end up breaking up or they go with their group of already existing lenders? Is there any read through about whether that's a good LME or a bad LME or just in general?
I think the determinant of a good versus bad LME is how much time it gets the company, not necessarily who does it. But I think it was Tolstoy who said that every company defaults in their own way and all LMEs are the same. Yeah, so I think
that's when I think of Tolstoy, that's the quote.
Yeah,
I think
I nailed it actually. I'm thinking of an example in today's market that where an LME would have served the company quite well, but they couldn't credibly garner interest for an LME. So I think that actually would have been an excellent candidate for an LME had they visited the market earlier. Not going to say the name of that company, but they produce furniture. They were going to be tariff impacted. And I was surprised to see in the public filings that they ended up filing for bankruptcy when I would have expected, and I didn't do a deep underwrite of the credit, that they had enough liquidity to make it until they needed. I would have expected them to come to the table for the LME. So when that happened, I read the docket and they ended up filing due to tariff troubles. But as we know, no tariff figures have actually worked their way through net income yet. So it's interesting. I would have expected that to be a prime LME candidate because it's uncertainty. Really, the company just needs a little bit more time to model how tariffs would impact them, but instead they went straight to a filing. So that should just go to show you that I don't really know anything. I don't know what the future holds. I would have expected an environment of uncertainty, especially when many companies are going to be impacted by the same uncertainty, to actually inspire more LMEs to create more runway until companies can hire a proper banker and figure it out.
Yeah, I find that situation incredibly interesting because, I mean, back in my day when I was a practicing bankruptcy attorney, I mean, we would all walk into the room and there would be a capital markets partner, a debt finance partner, and the bankruptcy partner. And nobody ever wanted the bankruptcy partner to speak first. It was always like, how can we explore every other alternative? And so when you hear that, there are market participants who would have been interested potentially in supplying an alternative and then they filed for bankruptcy, you have to wonder sort of what happened there. What were they so certain of, especially when tariffs specifically, I mean, we go back and forth. Are the tariffs really happening? Are they not happening?
Yeah, but one can also make the argument that a proper credit provider would have asked for an underwriting that the existing term lender group. So perhaps it was that.
Yeah, makes sense.
Who knows? But that I would have expected that to be a big determinant of more LMEs in the future. For more LMEs to continue to happen in an uncertain environment, I think you need to underwrite away from the economic uncertainty and the macro of today's environment. Like our main product that we do in my fund is accounts receivable financings and securitizations. We utilize either the securitization basket in existing CLO docs, asset sale basket in existing CLO docs, something like that. In underwriting accounts receivable financings, you're really underwriting the credit worthiness and the ability to pay bills on behalf of the company's customers. So using Tropicana as an example, like Tropicana's customers would be grocery stores. So you're really underwriting the grocery store's ability to repay accounts receivables, and one can determine if that's more or less creditworthy than something at Tropicana proper.
Right.
But at least in that scenario, you're insulated from what happens to Tropicana.
Very interesting.
So those type of LMEs might continue because you're not relying on the same type of diligence that existing lenders or a longer term solution would provide.
So that brings me to my closing question, which is, what is the future of LMEs? Or is there a future for LMEs? It sounds like the answer is yes, based on what you've said.
Not all LMEs are created equal. I would say that if you're looking at an LME where it's a drop down of a self-monetizing asset, like working capital, that's not the same. If you think about the trading of a company that does a sale leaseback or that does an accounts receivable financing, the underwriting of that credit should suggest that there's no impact to trading. And then historically, if we look back at credits where we have announced one of our accounts receivable financing, there's very little trading impact. And that's because of two things. Like one, the existing credit group has already underwritten basket capacity, and that should be reflected in the trading price when they start to trade off, or they're near their weighted average life of before the loan is taken out. Like if they haven't done anything and they have basket capacity, the loan will start trading off because the existing lender group expects them to do something. And then number two, it's more cash to the corporate. It's more liquidity to the corporate if you do a sale leaseback, if you sell something and then the cash goes on the balance sheet of the company. So it shouldn't necessarily negatively impact. So if that's still an LME, then I think that should continue.
Yeah. And if you've listened to this podcast before, you know that I'm always lying when I say it's my final question. I always have a follow-up to the final question. And so for you, it's, I guess, as the world of LMEs continues, do you think that there's going to be more private credit deals or deals away?
Yes, because I think it's supply driven. Right now, there's so much dry powder chasing the system in private credit, so much so. And yes, some of it is mandate specific. Like most of private credit dry powder right now is in traditional plain vanilla direct lending, sponsor driven stuff. It wouldn't chase the type of situation we're talking about from an LME perspective, but there's a lot of dry powder in special situations land. And there hasn't been that many dislocations. Like 4 months during COVID and a couple months when there was like a supply chain issue in 2022. And aside from that, there's been very few pockets of true dislocation where a special situations lender can sink their teeth into. So if you think that supply determines demand, then yes, there should be more LMEs just from that perspective going to private credit.
It sounds like we're going to be very busy. Yeah. Which is always nice, I think.
Yes.
Well, thank you so much for joining me. This conversation was great. And if you have any questions or comments, please reach out to podcasts@9fin.com. Thank you so much for listening.